The stock market has gone up and down quite a lot recently, and REITs are no exception here, and some fall down harder than others. And that's where I think the real value lies when it comes to investing. STAG Industrial is such an example. This stock is down about 25% from their 52-week high, closing in on their 52-week low as a matter of fact. Meanwhile, the stock has been performing pretty steady and consistent, with a beat on both the FFO and revenue in the recent earnings. And with the stock going down quite a lot, the dividend yield gets pushed up, currently hovering around 4.6%, and of course the monthly payouts. So this begs the question, is STAG Industrial a buy right now? Let's do a full analysis and find out. STAG Industrial reported revenue of 199 million in the recent quarter, up 9% year over year, so we're off to a great start. Net income was reported at 52 million, up 22.6% year over year, also looking really good. Down the line, this results in a much higher net income per share. And moving on to one of the most important numbers for REITs, the FFO, we see that this number is up 7% year over year, which is still a great number, but much lower versus the revenue and the net income growth. Especially when we take a look at the on per share basis, up only 3%. Down the line, pretty decent earnings, as we see most of the time with this company. Moving forward to the business itself, we see that STAG Industrial owns 591 buildings across 41 states. Occupancy rate is reported at 97%, which is a great number. However, there is one big problem for me, which is the WALT, short for weighted average lease term, reported at only 4.3 years. I prefer this number to be above 10. More on that in a second. Net debt to EBITDA is reported at 5.2 times, which is a great number. I prefer a range of 5 to 6.5 here. And going back to that WALT, we see that about 22% of the leases expire in 2026, which is something that worries me, especially if you take a look at the years after 2026. We see numbers above 10% each year. This is definitely something to keep our eye on. Retention rate is around 77%, so I think most of it will renew, but still we're going to see some losses here. Looking at the top tenants, we see that Amazon is the biggest, with 2.9% of the total ABR. So in terms of diversification, it looks really good, especially since the top 10 combined only represent 10% of the total ABR. It's the same with the industry breakdown. It looked really good. I prefer a range of maximum 10% here. So air freight and logistics is exceeding that number a little bit. But nothing that concerns me a lot here. Looking at the other industries as well, of course. The last thing that I want to mention here is the fact that credit ratings are currently sitting at B. I prefer A credit ratings here, but it's not bad actually. And now that we know a little bit more about the company, it is time to look at the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. STAG is a 5.9 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. And right now it is sitting at 12.9, indicating they are undervalued. Later in this video I will show you my 3 price targets for STAG Industrial stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 767 million, and in this graph we see that revenue went up really steady over the years. For a REIT, this is looking really impressive. Margins are going up over a longer period of time, and the operating margin is looking really good. However, both the gross margin and net margin are struggling most recently, something to keep our eye on. EPS is going up in the long run. It is not always steady and consistent, but that is very common for REITs. Analysis expected in the coming years EPS will decrease, which is really sad to see. I don't really see why this would happen. For the revenue, it is looking pretty interesting, with 7 to 9% growth in the upcoming years, pretty much in line with previous years. Return on assets is sitting at 2.9%, which is a low number, even for a REIT. Return on equity is looking decent, and the most important number, return on invested capital, is sitting at 2.8%, which is a low number. But it is slightly higher versus the 5-year average, so that's the silver lining here. Current ratio is at 1.36, which is a great number. Nothing really special to mention here. Right now, STAG has 3 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. STAG has 72 million in total cash, so they can't pay down a big chunk of the total debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run, which is a great thing. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. Most recently it is stabilizing a little bit. And when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 4.6%, which is a great number. Annual payout is at $1.49 and payout ratio is at 61%, which is below the 75% average for REITs. And keep in mind, STAG pays a monthly dividend. They have increased the dividend for 12 years in a row now, which is really impressive. The 5-year growth rate is a little shy to say the least. And in here, we see the dividends paid since 2015. They increased the dividends at a low rate. However, in the long run, this adds up. In 2015, they paid an annual dividend of $1.37. 10 years later, they pay an annual dividend of $1.49. And in this graph, we see the expected dividends in 2025, 2026 and 2027. Of course, this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase at a higher pace, which is really interesting. And overall, these dividends look really good to me, but how about the historical returns? I decided to compare STAG Industrial stock with the overall market, in this case the S&P 500. On the 5-year chart we see that STAG Industrial underperformed the S&P 500 with a big difference. STAG returned 52%, while the S&P 500 is sitting at 105%. And keep in mind, this is including dividends. It's also interesting to see that up until late 2023, STAG was able to match the S&P 500, but ever since that moment they are underperforming. On the 1-year chart, it looked really bad for STAG Industrial, with a minus 7% return. The S&P 500 is sitting at a positive 8% return. On the 6-month chart, it is even worse, with a minus 13% return for STAG Industrial. This time, the S&P 500 is hardly doing any better with minus 7%. On the 1-month chart, it is again STAG Industrial, who is beaten down a lot. This time sitting at minus 10%. Meanwhile, the S&P 500 is sitting at minus 4%. Bottom line, STAG was beaten down quite a lot. So this begs the question, could this be the perfect moment to buy STAG Industrial stock? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth, I'm filling in 5, 7 and 9%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin, I'm filling in 24, 26 and 28%. For the free cash flow margin, I'm putting in 48, 50 and 52%. For the PE ratio, I'm putting in 20, and for the price to free cash flow, I'm putting in 15, 17 and 19. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, STAG Industrial stock is at $32. I hit analyze, and we see a few green numbers. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $28, we have a mid price target of $36, and we have a high price target of $47. To me, the mid to high price target is the most justified here, indicating that this stock could be undervalued right now. Which price target do you think is the most justified here? Let me know in the comments down below. My final conclusion on STAG is that I really love the company. It has a decent position in my portfolio, but it is definitely not the biggest REIT I own. Most fundamentals look pretty good, and they have been performing quite steady and consistent. From a dividend point of view, things also look really good. They pay a monthly dividend, which is always an interesting thing, but above all, it is really safe and consistent. From a value point of view, I really get excited. The stock is beaten down quite a lot in the past few months, and I made the decision to increase my position again. But what are your thoughts on this stock? Let me know in the comments down below. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.